What we did in building the Rushtush brand and the Rushtush business, a lot of it was shaped around organically growing the business without taking on too much external finance. So what that meant was the business grew and still grows a lot slower than what it could grow at. But at the same time, the spin-off to that was it was growing at a more sustainable way. So instead of taking on debt, which with the interest payments and the interest rate increases, then increases volatility in your cash flows, we grew with equity, and that allowed it to be more sustainable. So there was more certainty, and that's why the business has been going for a number of years. In terms of key financial milestones, I think that for us, a big part of it was once we managed to get recurring income or to be comfortable that regular monthly income could cover our key overheads, our fixed overheads, our salaries, and important things that went off monthly. That was a big sigh of relief, because then we could start reinvesting in the business and reinvesting in growth. And that allowed us to take on more people, expand our products, and things like that. It's very important when growing a small business to keep your finger on the pulse, because the nature of business, especially small business, things move fast. You make decisions quickly. But if you don't have time, if you don't take the time to evaluate the impact of those decisions and assess, you made this decision, how did the business react? Was that the right decision for the business? If you don't do that assessment, you will not know whether the decision you are making are having the impact that you expect them to have. So that's extremely important. So I think that the mechanisms and the tools that one should use is budgeting, cash flow budgeting, but more importantly, revisiting those budgets. Once you put the budget in place, are you assessing whether what you expected it to achieve, has that been achieved? So continuously revisiting and reassessing and reevaluating and holding yourself as the owner of the business accountable is important. Being honest with yourself, because the data and the results will be seen in the business and in the cash flows. And if that data is telling you something that is hard to believe or it's hard to stomach, sometimes you need to have a reality check and accept what that is. So having processes like budgeting, and if you're not somebody that can do that, there are people who are able to assist small businesses in budgeting, in cash flows. I think that's an extremely important thing to bear in mind. And then also not to grow too quickly. Many small businesses, they have success early on, and they have cash flow challenges because they want to grow, and so they maybe invest in too much working capital, and it might take them time to flush that stock. So I think understanding your cash flow requirements and growing in a measured way is sometimes a more sustainable solution. Many people, when it comes to funding or when it comes to business or starting a business, I think sometimes people feel it glamorous to run to the bank and succeed in getting a loan from the bank. When understanding what funding you need in running your business and how to fund your business, I think, and what we've done to understand our business, is first to assess what are the requirements, how much funding do we need to run this business sustainably, and then understand what are the buckets of capital that I can use to fund the business. There's equity, there's simple vanilla debt, or simple debt that you take from the bank. There is hybrid debt or mezzanine finance, which is part equity, part debt. In each of those buckets, they each have their nuances. So with debt, obviously that's got interest rate repayments and capital repayments. With mezzanine finance, it's predominantly more expensive, so you have a more expensive interest rate because they're taking on more risk, but they also have an equity component where they might get a preferred dividend, or they might have first call on any returns from the business. And then on the equity bucket, one could finance it completely yourself, or you need to then take a decision, how much of this business am I prepared to give up in order to fund it adequately? Because there might be partners who are willing to come on board, but you would have to give up some control, or you would have to dilute some of your ownership. In some instances, you don't need to own 100% of the business. You can still have control if you own more than 50% of the business. you have voting control, and you also, in fact, have operational control if you're fully involved in operations. So when it comes to financing, you first need to understand what is it as the entrepreneur, as the founder of the business, what is it that you want out? How much control, how much ownership are you going to be comfortable with? How much, if you expect to make profits, how much of the profits are you willing to share? What percentage of the profits are you prepared to allocate towards interest repayments and bank repayments? Or what percentage of the profits are you prepared to share with other partners? And then also to understand these other partners that I potentially bring in, what qualities do they bring on board? Am I going to be able to work with them? Even if you're talking about debt or institutions that provide debt, sometimes those people can be difficult. So essentially you bring partners into your business, and then you need to understand what you're comfortable with and understand the parameters with which you're comfortable in working. So there are many areas where the banks have small business funding. You get the national NEF, the National Empowerment Fund, which has facilities for empowerment for small businesses. So there are businesses that also offer small business funding, and a quick Google search will give you many answers. But each of the banks also have arms that are able to provide this, and there's nothing wrong with giving your banker a call and understanding what they have on offer, but also importantly to understand what comes with that funding. What are the requirements, what is the criteria, and what parameters are they expecting you to work within. Starting a business can be risky, but there are steps. I would say they're habits or they're things that one needs to build into the way you conduct yourself that can be control measures to reduce the risk of business. Because of the excitement, because of the thrill of starting a business and the initial success that comes with it, there might be the need to grow faster than you want. And I think it's important to understand that one needs to sometimes keep things simple, and keep things small and grow smoother. That is a big factor that something that when Rushtush started her business, she kept her range quite small, and over time she grew her range, she grew her offering, ebooks, and then went into athleisure, and then went into pharmaceuticals. If you grow too fast and you've got too many plates spinning, you're introducing more risk. The bigger you grow, the faster you grow, you're actually factoring more risk into your business. So sometimes it's easier to keep the team small, keep the offering small. Once you've waxed that, then you can expand. So every decision you take is a risk decision. So you either, depending on whether you go one way, you might be factoring in more risk, and another way you might be factoring in low risk. So I think one needs to assess your decision making, but initially until you've been able to build up a sufficient buffer, I think it's important to keep things small and grow at a pace that suits you rather than growing too fast. It can be exciting, but sometimes having a mentor is another control measure, somebody that's been there and done that, speaking to industry veterans that can also give some guidance. They can tell you some of the common pitfalls that you find in your sector and your industry. So I think importantly, keeping yourself in check through those measures will help in avoiding some of the common risks. The exciting thing about the future is that we live in a digital age. So you'll find that there are platforms for everything. There's Facebook Marketplace. It's made a marketplace. It's made a platform for people to buy and sell goods, services. There's the VodaPay app is a marketplace. FNB has a marketplace on their app. You can sell homes. You can pre-sell homes. Just on the internet, on any website, people can make a marketplace for anything, which allows itself for price discovery as well. But more importantly, because it's so easy to establish a platform to put your offerings out there, or to showcase what you do and what you offer, it allows people to evaluate your business easier, and it also allows you to find finance opportunities easier. So before, but maybe you would need to put an advert in the classifieds or do print media and word of mouth for people to understand what you do, to get the word out there, to get your products out there. I think with the digital age, information transfers a lot quicker. Pricing information transfers a lot quicker. Information about who your business is and what you do transfers a lot quicker. So from a finance point of view, it allows people who are potential financiers to know about your business a lot easier. They gain trust because they can get reviews, they can get feedback of customers, they can judge how well is your business doing, because customers will be giving reviews, Google reviews, or whatever the case may be. So potential financiers or investors in your business can monitor that. If they are online, they can monitor that, and they then gain a trust and growing confidence in your business. It makes it easier one day when you're looking for finance, firstly, to find people who are willing to finance your business, for example, coming on board as an investor, as an equity investor, or giving you debt, and it makes it easier for them to evaluate you. There are also more opportunities to obtain finance quicker, because all these processes are becoming streamlined and digitized. To onboard, to put your application forms, to upload your cash flow forecast or your historical performance and your previous financial statements or anything like that. So it makes the turnaround time to obtain finance quicker. And then when I talk about platforms, it allows you to find these platforms where you are able to go to potential places where you can get finance easier. Whether that may be small business finance, or equity investment, or venture capital investors coming into your business, or private equity firms. But I think importantly, with the digital age, it allows for information flow a lot quicker, and that allows for that's essentially the progress in finance, where you can obtain financing easier. If you listen to everything that I was saying, a lot of it is evaluate, assess, reassess, come back, evaluate, and assess, and hold yourself accountable. So I think an important factor is to, like for example, when we talked about setting expectations, setting goals, setting objectives, setting a time frame with which to achieve those objectives, and at the end of that time frame, assessing, have you achieved it? How close are you? Or how far are you from achieving that? Or have you exceeded your expectations? And then also being honest with yourself and holding yourself accountable and saying maybe this isn't working or the following is working, and then persisting with something that's working and re-looking at something that isn't working, rather than continuing to hammer away at something that isn't necessarily working. But the only way you can do that is, things move so fast in a small business, you very seldom have the discipline, or it's difficult to instill the discipline to hold yourself to account or to evaluate or reevaluate something. Something that didn't work now might work in 6 months' time. It might have been a timing issue. You maybe launched the product at the wrong time of the year. So it doesn't necessarily mean it would have failed. So you need to really take the car apart, take the wheels off, have a look under the bonnet, take the engine out, do the oil change, and really evaluate yourself and the decisions that you're taking for the business, and evaluate how the business performs when you take those decisions. I think that's an important one. Even the biggest companies do it, by the way. They've got budgeting. Their finance departments are huge. They're doing strategy meetings. They're reporting back on their past quarter or their past month's performance, and in that they're setting expectations for the next month or the next 12 months. And when they do those strategy meetings or whatever the case may be, they're evaluating where are they going, how far are they from achieving the goals that they set at the last meeting. So if a big company is doing that to run an organization, what's stopping a smaller company that should be simpler? All your ideas are in your head. It's all about keeping yourself honest.